Hi, I'm Alex, welcome to the channel and thanks for tuning in. So in today's video we're talking about momentum and relative performance and why this is so important for a stock. It's something that often doesn't get given enough consideration by investors, but whether on the right or wrong side of this, it's something you definitely need to keep in mind. It's also something which is going to continue becoming more and more important, so if you want to become a better investor, then this is an important video to watch. At the moment, this is starting to look like an attractive dynamic at play for HITI, so we will look at this as an example of why it's important and what impact it can have on a stock price and why. Before we get into it, please smash the like button. In our battle against clickbaity, misleading content, it's so helpful when you do like the video in letting the algorithm know that it doesn't only need to recommend and push the sensationalist content. It's often misleading and ultimately it's not good for investing YouTube in the long run. You're doing a great job so far, so please keep it up. If you're new to the channel, then make sure you're subscribed. If you're interested in investing, learning more about it and understanding how you can generate better returns in the ways that professional investors do, then check out the new video series on the Patreon page. As always, I'm not a financial advisor. This video is purely for educational and entertainment purposes only, but let's get straight into it. When we think of relative performance, we're merely saying the performance of one stock versus an industry index or the overall market, somehow comparing one specific stock to a selection of others. Momentum is different, and in this regard we're using it to mean when there's a move towards greater volume of buying pressure than there is selling pressure, saying this is positive momentum, which drives up the stock price. Negative momentum would be the opposite, when the sentiment shifts and there's an increase in the selling pressure versus the buying pressure, which drives the stock price down. So while these are fairly simple concepts, many investors seem to be unaware of the importance and significance which these can have on a stock, specifically those which have institutional investors, and most specifically ETFs. Now, ETFs are important because they act as a good way for investors to get exposure to a specific sector and investment theme. The role of the ETF manager is to ensure that the allocation of specific stocks within the ETF is appropriate to at least perform in line with, but hopefully outperform, the broader sector or market that it may be tracking. They're active in their management, and so they will change their position and allocate towards specific stocks based on how that stock is performing versus the market, i.e. its relative performance. Now, one quick digression here is in relation to ETFs and their role in the overall market, and why this dynamic is going to continue becoming more and more important, and why you as an investor should be on top of this dynamic. ETFs have experienced tremendous growth over the last decade, with global AUM, assets under management, in ETFs being fairly small 10 years ago, versus today where it's nearly $9 trillion of capital within ETFs. Still, versus mutual funds, this is tiny, which by comparison stands at around $40 trillion. However, there is a transition at play here, and that is accelerating. Now, the latest example of this was perhaps JP Morgan's announcement that it would convert 4 of its actively managed mutual funds with 10 billion AUM into ETFs. Now, this follows a similar move by Dimensional Fund Advisors and many others which are in the works. Bloomberg Intelligence predicts that over the next decade, $1 trillion of mutual funds will actually be transferred into ETFs. Alongside this conversion, there's the growth in new funds, that being new fund formations, whether it be mutual funds or ETFs, and in this regard it sits firmly in the favour of ETFs, i.e. more ETFs are being founded and started than mutual funds. Now, to continue digressing, ETFs have historically just been written off as passive investment vehicles, and while the majority of capital in ETFs probably does fall within this category, the ETF has also evolved and should be seen as more of an adaptable wrapper that can almost include any investment strategy. We're seeing more and more leveraged products within ETFs and with derivatives and other synthetic financial instruments as a means of generating greater returns for the ETFs. Now, I'm not saying that the mutual fund is going away or disappearing, definitely not. But what I am saying is that ETFs are becoming increasingly important, and they will likely be a greater proportion of AUM than they are today. Anyway, back to the point. Why does this matter for an investor in a specific stock? Well, it all comes down to relative performance initially. If a stock is outperforming a sector in terms of its stock price, then a good manager, in order to ensure the best returns for the ETF, would ensure a greater allocation to those stocks which are outperforming and a lesser allocation to those stocks which are underperforming relatively. Indeed, if an ETF has not yet established a position in a specific stock, then strong performance can be a catalyst for them being considered to be included. Now, let's quickly pull this into a real-life example with HITI, and in recent weeks it has delivered superior returns for investors versus other stocks in the same sector. Indeed, this is a dynamic which can be observed over the past year at different time intervals, as we have looked at in a previous video. In order to ensure the best performance, ETFs will need to start establishing a position in HITI in order to capitalise on the strong stock price performance relatively versus the sector. Now, the inverse can also be true for a stock. If its stock price performance is weak versus other stocks in the same sector, then ETFs with an investment in that company may seek to reallocate that capital into other companies where a greater ROI can be generated. This dynamic though can be very interesting and can have a very real impact in driving momentum. As a company is outperforming the sector, a couple of ETFs may decide to increase their exposure to that specific stock, as it will drive superior returns, and so this in itself creates buying pressure. This is specifically pronounced in stocks with a smaller float, again HITI being a good example of this, but Tesla has also benefited from a similar phenomenon, which we will come back to. Now, with the increased buying pressure from these ETFs, the stock price increases further, and this then drives even greater outperformance of the sector in stock price, which then further increases the demand for that specific stock. Again, the inverse is also true, with poor price performance driving negative momentum and driving the stock price down even further. Now, this is a dynamic which investors should make sure they're aware of, as being on the wrong side of it can seriously harm your returns, especially if you're following a strategy such as blindly buying dips. I've seen this on so many stocks recently over the last 6 months, and a reversal of this trend can take quite some time, if indeed ever at all. As ETFs become an ever greater proportion of the market too, this will just become an even more important factor and also drive greater volatility. Now, it's not just ETFs that can drive this momentum though. It can be negative momentum from exits from big investors, perhaps pipe investors as we've seen in many of the big SPAC deals recently. So I mentioned Tesla earlier, and you're probably wondering how this makes sense for a company with a huge float like Tesla. Well, this actually was a phenomenon that was at play when Tesla got included in the S&P 500. Suddenly, almost overnight, all the S&P 500 tracker ETFs had to establish a position in the company relative to its share of the index, just to ensure that the exposure was suitable. This buying pressure created positive momentum, which in turn drove the stock price up further. Stock price performance of Tesla was then better than the market, and it required then the investors to have a greater share of Tesla as part of the index, which then drove more buying pressure as they were acquiring more Tesla shares. And this became a bit of a cycle, and is part of the catalyst for the phenomenal rally in stock price from October to December last year. So with that said, it's clear how momentum and relative performance can be so important for investors to keep an eye on when investing. Clearly, you don't want to be short on a company which is benefiting from the positive momentum dynamics, and you want to be careful when you're in a position in a stock, specifically blindly buying dips, if the sentiment is poor and there's negative momentum. Anyway, thank you so much for watching. I hope you enjoyed the video. If you did, please smash the like button. If you're new to the channel, then make sure you're subscribed. Check out the Patreon for other exclusive investing content. And as always, please let me know your thoughts and comments in the comment section below. I find it so interesting to hear the different thoughts and perspectives, so please get involved. Thank you so much for watching, and I'll see you in another video.